There are thousands of trading strategies online, but very few that are actually repeatable, structured, and simple enough to execute under pressure. Most traders are not losing because the market is impossible. They are losing because they are jumping between systems, entering trades just because they want to take one without a clear checklist, overcomplicating charts, and reacting to every candle that moves. What I'm about to share is not something new or magical. It's a structured, repeatable, checklist-based approach that works exceptionally well on gold and silver because it aligns with how these markets actually move. This strategy is built around market structure, liquidity, and disciplined execution. In short, it focuses on structure, liquidity, and patience. Nothing more, nothing less. When followed exactly, it removes guessing, removes impulse, and replaces chaos with clarity. Before we go any further, let me be very clear about something. This is not a promise, not a guarantee. The 70 to 90% win rate comes from strict execution, discipline, and only taking the cleanest setups. Also, this win rate isn't a perfect strategy. Trades are filtered aggressively, and many potential setups are ignored. Most people fail because they trade too much. Also, many people will not get the same results because most people do not follow rules consistently. This strategy only works if you respect every step exactly as I explain it. The strategy works because it forces you to trade less, but with higher quality. One rule broken is all it takes to turn a winning system into a losing one. This video is meant to be watched or listened to from start to finish. Every part connects. Every rule protects you from a specific mistake that causes traders to lose money. This is not a scalping strategy or a signal-based system. This is a decision-making framework designed to keep you on the right side of the market more often than not. Before going deeper, understand this clearly. Gold and silver are institutionally driven markets. They are highly liquid, heavily manipulated around key levels, and move with intent rather than randomness. These markets punish emotional entries and reward patience. They frequently sweep liquidity before making real directional moves, and they respect structure more cleanly than many other instruments. This strategy is designed to align you with that behavior. You are not predicting tops or bottoms. You are waiting for confirmation. You are not entering because price looks cheap or expensive. You are entering because structure, liquidity, and location all agree. Step 1. Identifying the trend on the 15-minute time frame. Everything begins on the 15-minute time frame. This time frame is critical because it balances clarity and precision. Lower time frames introduce too much noise, while higher time frames can delay execution. The 15-minute chart shows real structure without emotional distraction. When you open the chart, the first thing you do is remove all indicators. You do not need them. Price itself tells the story. Your job is to identify whether the market is bullish or bearish, and you do that by marking swing highs and swing lows. A bullish trend is defined by higher highs and higher lows. A bearish trend is defined by lower lows and lower highs. However, this strategy does not rely on visual assumptions. It relies on confirmation. Break of structure and change of character are only valid when confirmed by 3 candlesticks closing consecutively in the direction of the break. This rule is extremely important and removes most false signals. In a bullish trend, a valid break of structure happens after a retracement. That retracement must consist of 3 bearish candles closing below each other. These bearish candles must close below the previous candle's close, and they must close beyond the wicks, not just the bodies. This shows real selling pressure during the pullback. Once those 3 bearish candles complete the retracement, the next impulsive move that breaks above the previous swing high confirms the bullish structure. Without this retracement sequence, the break is ignored. In a bearish trend, the opposite applies. A valid break of structure happens after a retracement consisting of 3 bullish candles closing above each other. These bullish candles must close above prior closes and must close beyond the wicks, showing real buying pressure during the pullback. When price then impulsively breaks below the previous swing low, structure is confirmed as bearish. This rule is not negotiable. If there are only 1 or 2 candles, the structure is not valid. If the candles do not close beyond wicks, the structure is not valid. This forces patience and keeps you aligned with real momentum rather than manipulation. Once structure is confirmed, you mark your swing highs and swing lows clearly. These levels will later serve as targets, invalidation points, and liquidity references. At the end of this step, you should know one thing with certainty. Are you looking for buys only or sells only? You never do both. Trend direction is your bias, and bias must be respected. Step 2. Marking your point of interest. Supply or demand or order block. Once the trend is established, the next step is identifying where you want to enter. This is your point of interest, also known as supply or demand. If the market is bullish, you look for demand zones. If the market is bearish, you look for supply zones. But not every zone is tradable. The quality of the zone matters. A valid demand zone in a bullish market is an area where price previously dropped briefly and then moved away aggressively to the upside. A valid supply zone in a bearish market is an area where price rallied briefly and then dropped aggressively to the downside. Strong displacement is key. Weak reactions are ignored. Location is everything. When buying, you must be buying at a discount relative to the recent high. When selling, you must be selling at a premium relative to the recent low. Buying high or selling low destroys risk to reward, even if direction is correct. Your zone should be precise. It should not be oversized. Wide zones reduce accuracy and increase risk. The goal is to define where institutions previously stepped in with strength. At this stage, you still do not take trades. You are preparing. You are building a scenario, not forcing an entry. Step 3. Confirming liquidity toward your point of interest. This step is what filters average traders from consistent ones. Before price reaches your supply or demand zone, there must be liquidity available to be taken toward that zone. Markets do not move randomly. They move to collect orders. Liquidity exists above equal highs, below equal lows, at obvious swing points, trendline stops, and breakout levels where retail traders place stop losses. If you are planning to buy, you want to see liquidity above price that gets taken before price drops into your demand zone, or internal liquidity that fuels the move downward. If you are planning to sell, you want to see liquidity below price that gets taken before price rallies into your supply zone. This tells you that the market is preparing. It tells you that orders are being collected. When price moves into your zone after liquidity has been taken, the probability of reaction increases significantly. If price moves into your zone without any liquidity being taken, the setup is weaker. This strategy does not chase weak setups. It waits for alignment. Step 4. Executing the trade inside your point of interest. Once liquidity has been taken and price enters your point of interest, execution begins. There are 2 execution styles, and both are valid depending on your risk tolerance. The aggressive entry involves entering as soon as price taps into the supply or demand zone. The stop loss is placed beyond the zone, where your idea is clearly invalidated. The target is placed at a logical structure level in the direction of the trend. This approach offers the best risk to reward, but requires emotional discipline. You accept drawdown as part of the process and allow the trade to play out without interference. The conservative entry requires confirmation. If you are buying, you wait for price to enter the demand zone and then wait for a bullish candle to close outside the zone above it. This confirms that buyers are stepping in. If you are selling, you wait for a bearish candle to close outside the supply zone below it, confirming seller presence. This approach reduces risk, but also reduces reward. Some trades will be missed. That is acceptable. Consistency matters more than frequency. Once entered, you do not manage the trade emotionally. Stops are respected. Targets are respected. The trade either works or it doesn't. No strategy survives poor risk management. You risk a fixed percentage per trade. You never increase risk to recover losses. You never revenge trade. You never enter without all conditions met. Losses are part of the business. This strategy works because losses are small and controlled, while wins are allowed to reach logical targets. This strategy is demanding. It demands patience, restraint, and trust in your rules. Most traders will fail not because the strategy doesn't work, but because they break one rule and then blame the market. If you treat this approach as a checklist rather than a suggestion, it can completely change how you trade, not just your results, but your mindset. Consistency comes when decisions are no longer emotional, and when emotions leave trading, clarity enters.